My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Look, my friends, we're just trying to make a little money here. Because my job is not just to entertain you, but to educate, to teach you, especially about days like today. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. It's official, people. When we buy stocks, we're no longer fighting the Fed. Based on what we heard today, the Fed is now a little more worried about a slowdown than it is about inflation. And the averages reacted appropriately to that change, with the Dow gaining 512 points to a new all-time high, S&P jumping 1.37%, NASDAQ climbing 1.38%, a little more tepid than the others. Yes, when Fed Chief Jay Powell says the economy has slowed considerably, that's good news, not bad. It means that the Fed's now on the side of those who own stocks, not the ones who don't own any. Not only is the Fed no longer our enemy, it's much more likely to become our pal, assuming the economy stays on its current slower course. This is the about-face that the bulls were waiting for. It's the comeuppance for the myriad bears who never embraced the possibility that Powell could engineer a soft landing, a terrific soft landing. And this one's so soft it barely counts as a landing at all. Those bears are now trapped. There's nothing they can do except try to rip their legs out of the jaws of those bear traps. Oh, good luck. I'm told those things really hurt, especially when you're short. When you get your first sign that the Fed's finally done with its tightening cycle like we did today, there are two ways to look at it. You can say we're now ready for rate cuts, perhaps as many as 3 of them next year, and 3 rate cuts would mean smooth sailing for stocks. Bonds will lose their attractiveness versus stocks real fast. It's a Goldilocks situation, not too hot, not too cold, just what the bulls want. That's certainly what we saw in today's action. Best performing stocks, they were the housing stocks and the bank stocks, not tech. The home builders were already roaring. Hey, Toll Brothers just announced a brand new 20 million share buyback after the close. They get the zeitgeist, but the banks are new to the party, and the bank stocks that were most shunned made the biggest moves higher. These stocks are all saying that happy days are here because, well, mortgage rates, auto loan rates, and credit card rates are all about to come down, so defaults will shrink. But I said there were 2 ways to look at the Fed's stance. What I just laid out is the glass half full version. What about that glass half empty alternative? This view says the Fed's done tightening and might have to cut rates a bunch of times in 2024, but that's because it raised rates too aggressively, with the rates going to their highest levels in 22 years. So we can only hope nothing's going to go horribly wrong, just wrong. Jay Powell takes questions from the press, and most of the reporters seem fixated on this issue. After today's initial jubilation, which will probably extend to tomorrow, I expect the glass half-empty crowd to take over the microphone. But we didn't hear that pessimism from Powell. He actually did seem as jubilant as he ever gets, which admittedly isn't saying very much. In fact, in his typically understated way, he actually took a shot at all those recessionistas gone wrong. They'll probably continue to be wrong because, well, we got a strong, tight labor market, but more people are coming back to the workforce. That means wages are not going to soar. He didn't say, we got a soft landing. Nah. Of course, that's what I would do. But we did indeed get the soft landing. So let's declare it. With today's news, interest rates have peaked, and we now have the wind at our backs for some, not all stocks, and the wind is no longer in our faces because inflation is getting tame. Obviously, the market got ahead of the news. The average has been roaring for 7 weeks now, so there are no surprises here other than that the Fed now seems to think out loud and in unison that crushing inflation is now less important than avoiding a slowdown. Price stability has been restored. Again, we're no longer fighting the Fed. The first rule of when you can buy stocks without worrying about monetary policy. Powell doesn't want to declare victory. I'll declare victory for him. What about the second view, though? The one that says the Fed's only getting ready to cut rates because they're worried something about to go horribly with the economy. Lots of money managers actually came on television and said that immediately. Said the Fed overshot with its rate hikes, that the economy's in trouble, that a recession will happen real soon. I actually heard these people say this. Some even said we're in a deflationary moment where the economy's just going to stall out. Pancake. Don't they realize that in this movie the bulls gore the matadors and hook them on 2 horns? Ain't these people ever heard of Xanax? I don't know how people make this ill-advised argument when we just got strong employment numbers last Friday. Business is all right. It's just not red hot. But the more realistic, pessimistic camp says you already missed the rally. Now it's time to accept that the bull market's long in the tooth. I heard that, too. Headed to the slaughterhouse. Heard that, too. As the true slowdown is yet to begin. This camp had its way. With lots of people buying the slowdown stocks, think Procter & Gamble, Constellation Brands. People still drink beer in a recession. The good news here is, of course, that everyone was buying something. That's how you get a market with great breadth. Does it mean the run of the Magnificent Seven is now over as people go buy KeyCorp and Wells Fargo or used car companies like CarMax and REITs like Boston Properties? Well, you know what? Yes, when it comes to percentage gains. When it comes to percentage gains, I take any of those over the 7. And by the way, I never knew which of the 7 was Yul Brynner and which was Steve McQueen anyway, at least not with their hats on. Should you strap yourself to the bullish mast and not listen to the sirens of those who are doubling down on negativity, the ones who say that we're headed for a hard landing despite all the evidence to the contrary? Yes. For now, you need to ignore them. It's true that the market's been up for 7 weeks, but not everything, not the financials. They sell at such incredibly low levels that I think you can buy almost all of them, especially the regional banks never came back after the mini banking crisis in March. Deep cyclicals, they haven't run that much either. They're incredibly cheap because their stocks will reflect the recession that I'm now telling you we're not going to get. Told you Caterpillar was a winner and Stanley Black & Decker, why the Travel Trust has such big positions in them. They're made for this moment when the Fed's no longer your enemy. Hey, same goes for anything auto-related. They're way too cheap now. Oh, my, Ford and GM, fine with me. So far, there's been a ton of money made in all sorts of tech, software, hardware, cybersecurity, artificial intelligence, all the things that tend to hold up in a slowdown. But now it's time for Bank of America and J.P. Morgan to shine, for the autos to be bought, for the deep cyclicals to rebound like crazy. Yes, the big money's already been made in tech, although I think that there's still some small money coming. But if push comes to shove, I got to tell you, I prefer J.P. Morgan, Morgan Stanley, and Wells Fargo. I always like that stagecoach to Microsoft or Alphabet, at least when it comes to percentage gains. By the way, that's why every member of the 7 gave up big gains after the Fed's news, with the exception of Tesla. Bottom line, sure, the easy money's been made in a couple of sectors, mostly tech. But now it's time for a bunch of other sectors to shine. The economically sensitive ones that were supposed to be crushed by an inevitable recession. They've been down there being stomped on by the bears and bulls. That's over. These stocks aren't liked. May I suggest you cotton up to them because the plane has landed. Our seatbelts are unbuckled. We're in the overhead taking down our bags. We're going down the gangway, calling an Uber, and getting the heck out of an airport. Yes!
House of pleasure.
Wade in North Carolina. Wade.
Hello. I was wondering if you think Lululemon has hit the top, or is there still room to grow past 500?
Well, how about the fact that all the bears said it was a bad quarter and then it went to an all-time high? I mean, you know what? In the old days, I used to just call them stupid. But you know what they are? Stupid. It's a good stock. Andy in California. Andy. Andrew, speak to me. Come on, Andy. Andy,
hey,
come on.
Hi, Cramer.
Andy!
This is Andy from the home of the new AI revolution here in Silicon Valley. Thank you for taking my call.
No problem. What's up?
And thank you so much for you and your staff for all you do. I've learned so much from you.
And you are very kind, Andy, and we're all fired up here, and I love this. Andy is the man. How can I help?
Hey, I have a question about Honeywell. So when Dave Cody ran Honeywell, I made a lot of money in Honeywell with you. You haven't opined on it in a bit, and it seems like it's been stuck for about 2 or 3 years now. Do I just swap it out for another industrial, and would that be a better take?
Andy, listen to me. Honeywell is made for this moment. It's the kind of stock that is... It is down 5% for the year. It's been hated by bulls, bears, everybody, all sorts of animals. And next thing you know, the Fed does this, switches direction. I mean, one of those Fed members should have just said, you know what I meant to say was buy Honeywell. Could I be more clear? The easy money might have been made in some sectors, especially tech, AI, you get it. But now it's time for the economically sensitive areas to shine. So pick up some banks, some home builders if you want to. They've moved a little, but I don't care. You know why? Because Jay Powell got us to land softly. It's a nice ride. On Mad Money tonight, we're always on the lookout for best-of-breed stocks, and in the struggling REIT cohort, could Prologis be the one investors should be looking for? I'm digging into the story with the company's top brass. Then, with infrastructure spending set to continue into the new year, I have spotted an under-the-radar player that I think could benefit and be really interesting at these levels. I'll reveal the name. And don't be reported at the bell. I'm running through everything you need to know with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.